is the Angel Next Door podcast, where we will talk about all things angel investing, what it is, who does it, how do we find them, what does it mean to invest in an early stage company. If you have ever wondered how you can affect the change you want to see in the world, then tune in to learn more. In this episode, I'm talking to Colin McCrea, partner and CFO at Eqvista. I've watched founders make costly mistakes as they set up the equity structure for their companies. And what do they do about stock options when they want to hire in the future? These and other valuation questions are answered as we learn about Eqvista being a more affordable and possibly even free alternative to the main and pretty much only competitor out there. Plus, Colin shares his expert advice on essential tax strategies and compliance tips that could save startups a lot of money and hassle. Enjoy the show. In this episode, I'm talking to Colin McCrea, partner and CFO at Eqvista. I've watched founders make costly mistakes as they set up the equity structure for their companies. And what do they do about stock options when they want to hire in the future? These and other valuation questions are answered as we learn about Eqvista. Well, hi, Colin. Welcome to the show.
Hi, Marcia.
Well, it's nice to have you here today. I know we met recently. I was just fascinated by what you're doing at Eqvista because I hear from companies a lot that they want something that has to do with cap table management, but they're not really sure how to do it. They're a little bit worried about going to some of the bigger providers because they're a little more expensive. They're a little more upstream. So why don't we start out? Tell us a little bit about your background first, and then we'll get into how you got to working with Eqvista.
Yeah. Thank you so much for the introduction. So I went to school for accounting and finance, and then I was doing work at a CPA firm, and then I stumbled upon Eqvista when we started back in 2018. So that was like 6 years ago, and that was when the market was more wide open for cap table providers, and it was more like the Wild West back then. Like people didn't really know where to go to, and everything was probably overpriced than what it is now. And we just thought there should be a better way to do it, a more affordable way for founders and just something more accessible. So we just started off building it gradually. And then now we have a user base of around 15 or 16,000 companies on the platform. And they kind of range from startups to pre-IPO companies and everywhere in between. But yeah, I mean, it's really nice to have a solution that caters to both startups, even like one-man bands, to ones that can accommodate several hundred shareholders. And then I naturally also, right now I'm leading our valuation team for foreign NA valuations, which kind of goes hand in hand with cap table management because you want to know what the strike price is or the fair market value of your common stock are. I'm helping a little bit on both sides of cap table and foreign NAs.
Okay, great. So one thing that we haven't talked a lot on the podcast about before is cap table management. We haven't really done that. And we definitely have not talked about 409A. So let's back up a little bit.
Yeah.
Tell our listeners a little bit about what cap table management is. If you're a founder and you're thinking, okay, I have to start this. I've heard about this cap table management, but I'm not really sure even where to start. Tell us about that.
Yeah, I mean, cap table or capitalization table is basically a tool for tracking the equity in a company. And I know that for most first-time founders, that's the last thing that they think about. It goes in the back burner. They think about how they grow their business and everything else. But then as the company grows and things get a little bit more real, then they realize that they need to take it more seriously, not only for taxation purposes, but if you're bringing a lot of, maybe you have co-founders, if you have partners, if you have employees and investors, and slowly more and more parts of the pie is getting taken away. And then you might realize that you need to protect something or you need to make the equity as an incentive for shareholders. It's actually, I would say in the beginning, a lot of the companies, they use Excel, which is acceptable if you have a couple of shareholders. But then when you're onboarding more and more people, and especially when you have like vesting schedules, where it's like you're getting a little bit of the options every year, every month, and you're trying to like juggle having 20 or 30 people in your cap table, it's really difficult to do it on Excel, especially to keep everybody updated all the time. So that's when we see a lot of clients that they shift to like a software solution.
So take us back to, I'm a founder and I now am like starting my company and I'm going to split the shares between co-founders. When you see that happen, tell us a little bit about how that starts. And then once you start to bring on And once you start to bring on investors, then it's a different game. So you almost have to have it separated a little bit, but then it all does have to come together because you're still splitting up equity in some ways, either between common shares and preferred shares.
Yeah, I mean, let's just say you have two founders. The most common would be like a 50-50 split. There might be some where one person wants to take majority, but normally it's 50-50. And then when the company grows, you might have some key employees or advisors that you might give a couple of percentage points to before you have the investors come in. But when you do start getting investors coming in and you have either like a friends and family round where you have some, yeah, like friends or family that want to invest and help the company, then you have to start thinking about how much of the company you want to give up to them. And some of the companies where they just want to grow and they don't really think about it, they might be giving up, I don't know, like 30-40% of the company because they just want something to come in and make the company like a real thing. But then they realize after a while, they're like, I gave up a lot of my company. I shouldn't have done that. Typically, it's 15 to 20% on a normal like round with VCs investors. So yeah, I mean, you don't know it's too late until it is. So
Right.
it's good to educate yourself at the beginning. And we see a huge difference of how seriously founders treat equity for like first-time founders and founders who have exited like a couple of companies. Like their perspective on it is a lot different.
I could totally see that. I mean, I worry because I've seen so many entrepreneurs where they have given up that equity at the beginning because they thought, oh my gosh, I just need to get some money so I can get to the next milestone so that then I can go out and pitch to more investors. But then they give up too much and it ends up becoming a snowball effect. So then they get to a point where they can't continue to raise unless they recapitalize, which is always a difficult thing to do if you've already promised and already signed away parts of your
Mhm.
company.
Yeah, and like some of the extreme cases we've seen are like companies who've raised in 2021 where the valuations were like sky high
Right.
and they had really high pre-money valuations. And now it's kind of come back down to earth. And a lot of them actually might have like down rounds or they have extended rounds. And they're just giving a lot of equity to keep the company running because their burn rate is really high. Like they're losing a lot of money. So that's where they just keep losing these chunks of equity. And if some of them get acquired, they have such little ownership in the company left. It's surprisingly, even though they sell the company for $100 million, that they're left with close to nothing. It's really interesting to see.
Yeah, it's so sad. That's a really good point about 2021 because the valuations were so crazy then. And then we
Mhm.
started to see them really come down in 22, 23, even here in 24, we're still seeing companies struggle to
Yeah.
fundraise.
Mhm.
They're really having a hard time. They're having to do down rounds or extended rounds, as you say. I've seen so many companies doing extended rounds. And that just means they're hitting they could even be hitting milestones. They could be hitting those milestones and then they are not able to show it in the valuation because they just raised on too high a valuation before, gave too much of their company away.
Mhm.
Wow. All right. So then let's talk a little bit about what a 409A valuation is.
Yeah, I mean, a foreign A valuation, it's strictly for stock options. So let's just say that you have an investment coming in, and normally the investors would recommend that you set aside about 10, 15, 20% of the company for new staff coming in. And that's called an employee stock option pool. And then in order to set the like exercise price or strike price on those options, you need to get a third party valuation done. So you make sure that you don't have it too low. So the IRS is, oh, that's a little bit too low for what you should be issuing them at. So you have other firms, either valuation firms or cap table firms or kind of combination of the two, where they help to conduct this 409A evaluation for you to do that.
And that way you can set a price on what the options will be. And would this be the case? Because when a company is actually raising money, so when the company's raising money, they know the price because they're carving out the option pool. And if they were going to give out options at that point, they would just use the price of the last round, correct? Or the last price that they had issued stock at. But if now time has passed and you want to issue options outside of a raise, then you have to get the 409A. Is that right?
Yeah, you usually have to get them done at both points. But yeah, if it's been a long time and you don't know what kind of the share price is anymore, then you'd probably have to get a 409A to update that for the company.
So there are times though that a company would have to get a 409A valuation for the options, even at the same time that they were fundraising?
Yeah, let's just say you just closed a round and the share price was like $10, but that's on preferred stock. Then you want to get the fair market value of the common options as low as possible for tax purposes. So you get a 409A we use a model to get it as low, acceptably low as possible. And then you can issue it at that price.
Okay, good point, because you're talking about two different types of shares. So even if they were raising, then you would need to value the common shares because it's the preferred shares that have the price because that's the money that you just raised, right?
Yeah, and like one misconception is like a lot of the companies they think that you can use a foreign NA to attract investors, or you can use it for some other purpose that's not for stock options, which you technically can. But if the purpose of the foreign NA is to have a very low price, then obviously the investors won't think very highly of it. I think the misconception is that it's a valuation can be anything, but actually a valuation is for a specific purpose. It's for investors, it's for stock options, it could be for a shareholder dispute. So there's different purposes for each type of valuation.
Interesting. So if somebody does a 409A then on the common shares and they issue options to an employee, tell us a little bit about the process of how that works. Does the employee have to pay for something then? And tell us like how that whole option thing works, vesting. Give us a little.
Yeah. Yeah. So there's two types of options, which is incentive stock options or non-qualified stock options, NSO and ISO. ISO, they're only for employees of the company and they get like special tax treatment. So even if you have options, you hold onto them and you exercise, you won't have to pay any tax. Maybe AMT, but usually not. And then once you sell those shares for a gain, then you'll pay tax at that time. But if you're giving options to advisors or contractors or people out of the country, non-employees, then once they exercise, then they'd have to be paying tax on that. But yeah, most options, they would have a vesting schedule because you don't want to give a bunch of options away to an employee and then they get 1% of the company and then they quit the next day. So you want to protect the company that way. So you might give them options and they earn them over a period of like 3 years or 4 years. So it's slow, so you know that they're committed to the company and they want to see it grow as well.
Yeah, absolutely. That makes a lot of sense. Yes. So then with Eqvista, tell us a little bit about what happens when a founder comes onto the platform, how it works, and all that kind of stuff.
Yeah, so I mean, for the smaller companies, we offer a free plan. It's up to 20 shareholders because it's there to support founders, and usually the cap table is not too complicated. So yeah, you can onboard yourself. It only takes 1 or 2 minutes. You can create a company. You can start issuing shares to you and your shareholders. And then as you grow, and if and when you might need a 401A or you might need some more advanced features, a lot of it's like kind of compliance features or like tax features on the platform. Then it goes to a paid version so you can mix them two together. Basically, when you grow to that point where you want to kind of treat it more seriously.
So there is a free program, which is awesome because then that kind of incentivizes some of the smaller companies to get started. Because sometimes what I've seen is, like you said, an Excel spreadsheet's okay at the beginning when you only have a couple people, but then as it gets more complicated, I feel like as the company's growing, then there's more things to do. The founders are running around with their hair on fire practically, and they're trying to get all these things done. And then it turns out that they're like, oh my gosh, I now have many investors, many shareholders, and now I have to go back and try to redo it. I feel like that makes it really challenging if you're trying to do it after the fact.
Yeah, and we also help with onboarding as well. So like you said, we've had some clients where they do it Excel, but it's really messy, and they just have all these like documents somewhere, and then we say just send it all to us. We can organize it and then put all those details onto the platform so it's more organized and they can just start using it right away. So yeah, we've had clients where we basically help them a lot to get them started.
That makes so much sense. And then you said you already have much bigger companies on the platform too, pre-IPO and everything too, right?
Yeah, and of course, like their needs are different. So they have a lot of shareholders, so they need more features that you can track and manage like a lot of people at one time, or you can send messages out to a lot of people or issue share certificates. So the needs a little bit different for the different companies.
Yeah, so you have a free plan. I have heard from some other people that your pricing plan is actually quite reasonable. And so it's pretty easy, even once a startup has to start with a paid plan, that it's still accessible to them. Is that right?
Yeah, the free plan up to 20 shareholders, and then once it's above 20, it's $2 per shareholder for the premium plan. So even if you have 50 shareholders, that's like $100 per month, which some people might think is too high or too low. If you're trying to manage 50 people at one time, the platform does save a lot of hours of manual work or emails back and forth. So it's just saving you a lot of time to do other things for the company. And then we also offer one with 4.9A. So depending on how big the company is, those prices can go up. But yeah, we're a lot more affordable, I think, than other companies in the market.
So if I'm an investor, it's also helpful to me because now I have a third party that's keeping track of the equity. It's also a place that I can log into as an investor and I can see my shares, how many shares I own, and I can also see the documents I signed. Is that right?
Correct. Yep. Yep. So the investors have access to all of that. They can see it all. Again, really quickly go into the cap table, see what's going on, and go out.
Yeah, I like that because I feel like trying to keep track of all the documentation is challenging. I mean, you have to be super organized in order to be able to do
Mhm.
that as an investor, and sometimes things happen. All right, well, great. Well, Colin, where would people go to find out about Eqvista and tell us more about where founders and investors who are helping founders should go?
Yeah, I mean, they can just go to our website or go to our contact page. But yeah, there's so many questions and so much information around cap table and equity management, and a lot of it's overwhelming for founders. So I mean, we have a lot of like resources online, either about the platform or just in general. But if people have questions, they can just send us an email. We're usually responsive. We'll respond within 24 hours. But I would say that a lot of the clients or a lot of companies, they do appreciate us because we'll help them in other facets rather than just selling them a product. We'll help them with some of the compliance is a little bit complicated too. There's like a filing called 83B, which is you're sending a form to the IRS about a fair market price. There's also QSBS, which is qualified small business stock. If you hold onto stock for longer than 5 years and it's technically a small business, almost like 100% of your capital gains can be exempt, which is could be like millions of dollars. So a
Right.
lot of the founders, once they hear about this, they're like, I never knew about this, and this is great. I really want to take advantage of it once I get close to the 5 year mark. So a lot of these little kind of tricks or compliance things that people just don't know about, they might ask us about that and we can help them with that.
That's great. In fact, that's so timely that you said that, Colin, because we just recorded an episode with Jeff Solomon, and he walked us through all the details of QSBS,
Mm.
all the tax advantages. So if you are a listener, you didn't listen to that episode yet, definitely go back and talk about that. But we did not talk about 83B. So just go over that briefly. I know we're now getting into like Angel 501 at this point, we're getting into some more advanced stuff here, but it's very interesting. And I think that's one thing that I've seen, especially employees and other founders, that they didn't realize there was this 30-day window that they had to get in the information for the 83B. So just explain that briefly, just so that people know, ooh, geez, I need to make sure I'm all over this.
Yeah, so 83B form is basically it's a form to the IRS telling them that you receive stock, or if it's for options, if you have early exercise options, and you're making a pre-payment on your taxes. So you're basically setting the, I guess, the entry point or the fair market value at that point in time. And then if you have any vesting later on, usually for restricted stock, all of that gain that you have is capital in nature. And you're basically telling the IRS like beforehand, look, this gain will be capital in nature. So later on, when I sell it and I have taxes, it shouldn't be income taxed, right? So you'll be gaining a lot of money that way. For some of the founders who just started a company, they'll be paying nothing because the company is not worth anything. Or if it's more established, some shareholders might be paying something. But later on, it could save you tens of thousands or $100,000, depending on how big the company is. But yeah, a lot of founders and a lot of people in the startup world, they just don't really know about this.
Yeah, I've seen a lot of times people are like, oh, well, let me send in the 83B election now. And it's too late. You had to do it in the first 30 days that it was issued to you. Yeah. Yeah.
And
People,
it ties really well in with QSBS too, because if you file that and then later you're filing for exemption, you're saying, I already did this before. This is really good evidence for this one. So a lot of it's tied in together, even with foreign NA.
Yes. It's almost like you're drawing a line in the sand with the IRS and you're saying, look, this is when I got the stock. This is what it was worth. And now later, if there's a gain, that gain is not ordinary income.
Yep.
Yeah. All right. Well, Colin, thank you so much for coming on the show today and telling us all this wealth of information. This is a lot of stuff we've never talked about before. And I love the idea of founders being able to have a free account at Eqvista so that they can get started on cap table management right away.
Thank you so much.
Hey, thanks for listening. To connect with me, visit my website at marciadawood.com. And if you're looking to learn more about investing in the changes that you want to see in the world, sign up for Anne and Bill Payne's ACA Angel University classes. You go to angelcapitalassociation.org, all one word, to find out the schedule. Many classes are offered, everything from the angel investing basics, fundamentals, risks, due diligence, term sheets, valuations, returns and portfolio strategy. And for a deeper dive, there are advanced classes which include capitalization tables, startup boards, and exit strategies. If you're not already a member of the Angel Capital Association, you can become one for the low price of $295 for the year, and that will give you unparalleled access to discounts, free webinars with a huge archive of content, networking opportunities, and much more. We'd love to have you join us. All content for this website is informational and not intended to serve as legal, tax, accounting, or investing advice. While Marcia, that's me, does serve on the SEC Small Business Capital Formation Advisory Committee, my views are my own and not the views of the SEC or my fellow colleagues on the committee. Our speakers and hosts are thoughtfully selected for their educational value, but their opinions are their own and do not necessarily represent the views of the host, me, or the Angel Capital Association, and neither specifically endorse the use of presenters' products or services. Listeners of the podcast should consult their own tax, investing, legal, or accounting advisors before making important financial decisions. All warranties, including accuracy, completeness, and suitability for specific purpose, are disclaimed.